right now reflects a very good time to be actually buying the S&P 500 equal weight as opposed to the S&P 500. So while we cannot time the market and see if this narrow breadth will change into maybe a broader breadth or if there's going to be a correction, what I can confidently say is that I'm getting the equal weighted basket at a significant discount to where it's traded historically.
Hi everyone, my name's Cam. I'm the CEO and co-founder of Investapal, and we're making investing accessible to everyone. I'm joined today by Nadeem. Nadeem has over 15 years experience as a seasoned investment strategist and portfolio manager, managing over $3 billion of money. Nadeem, welcome to the show.
Thanks, Cam, for having me.
So I figured today we could talk on a few different fronts. There's a lot of macroeconomic developments going on with the market. We have some Chinese data out, inflation data coming out. AI is very topical, so we can get to that a little bit later on. But curious to hear your thoughts right now on where do you see the macroeconomic environment and how can retail investors capitalize on some key themes?
Yeah, so I would say that there's a lot of mixed signals, a lot of moving parts in terms of the macro backdrop, and then if you kind of take it down all the way down to the micro level in terms of securities, it's definitely suggesting different things depending on the data points that we're looking at, right? So if we think about the macro side of things, first and foremost, the economy is slowing. Why is it slowing? Well, this is a policy-infused slowdown. Higher rates, not only by the Bank of Canada, but central banks globally, for the most part, have all been hiking. There are some exceptions to that, if you will, but for the most part, central banks are maintaining a rather hawkish path in terms of, or hawkish rhetoric in terms of their policy, right? So they want to remove stimulus from the economy, and they've been doing so over the past year, and that's largely attributed to the fact that inflation has been soaring globally across various regions to difference in terms of magnitude across both the developed and emerging markets. So, the economy is slowing, and that's by formula, that is by the goal of policymakers to on purpose, if you will. So that's flowing down to the real economy in so many different ways, right? Activity data, various consumer data, PMIs. So that's Purchasing Manager Index, and for many of you retail investors out there, Purchasing Manager Index is just a survey of the intentions of purchasing managers at various companies across the world. So if you think about a company that produces cars, what are their purchasing managers doing? Are they looking at buying more steel, aluminum, plastic, given the demand ahead of them? Right now, the expectations has cooled quite significantly from the peaks that we saw in 2021 and into 2022. So again, at the macro level, GDP, economic growth is slowing. Policy rates, broadly speaking, are tightening or remaining tight across both the developing regions. Inflation is falling down from the peak, but again, still relatively high. All intents and purposes from a historical perspective. But we're seeing, in some cases, if we look at the U.S. market, we're seeing this euphoria, right? Kind of like a mixed signal with tech rallying, the index rallying, NASDAQ rallying, and so on and so forth, right? So again, for investors that have been paying attention to the macro, and then looking at their stock portfolio and even their bond portfolio to some degree, they're seeing pretty reasonable gains, right, in some areas. So again, it's
Well,
it's a it's a it's a mixed bag for sure.
it does look like, we're both Canadian and we do take a global stance. Like I see the Canadian numbers that came out today. We're at what, 3.1% annualized GDP growth for the year. Do you think that's like late stage growth and we're kind of capping out right now, or do you think that the economy is still in full swing and they're going to keep hiking interest rates?
Yeah, so that's, again, that's a, lagging print for the Canadian economy. So definitely there are factors at play that cause this number to come in relatively stronger than most would have expected. And even Bank of Canada, Tiff Macklem probably wasn't expecting, a strong print that we saw this morning, right? So that will definitely alter, I guess, his policy decision, I would say, at the upcoming meeting. But I think what we're seeing again um, is just the lag effect of policy, right? So changes in interest rate typically take anywhere between 9 to 12 months to actually flow down to the real economy, right? And so if we think about just last March was when we started seeing central banks, for the most part, kind of begin their hawkish rhetoric and start raising interest rates. So again, we're still seeing only the initial effects to the real economy. For example, if you've had a fixed rate mortgage and you essentially locked in that mortgage 2 years ago at a fixed rate, or even 3 years ago, well, the 500 basis point approximate move in rates hasn't really impacted you. If you're a retiree and you don't have a mortgage and you don't have um, a line of credit, well, the change in policy hasn't really impacted you. And if you're not driving that much, well, the increases we saw or the volatility we've seen in crude prices hasn't really impacted you that much, right? It's probably been maybe on the food side, right? So again, the impacts of changes in policy and the downstream, effects on various people, corporations, etc., at the real economy level will vary, and it's going to have a bigger impacts on those that are, a little bit more sensitive, obviously exposed to all of the things that I've discussed. So if they have a variable rate mortgage, they have a high level of debt, whether it's mortgage or consumer debt or student debt, that's variable. Well, you're gonna feel the big grunt of that, right? So on and so
Absolutely.
forth.
I think, like there's been an expectation on the investor front that we're hitting the peak of interest rates right now. And that's why you're probably seeing tech rally substantially. Like for some context, tech typically gets valued off future cash flows, and the present value of that takes into consideration the interest rates behind that. So as interest rates go up, the present value of those cash flows goes down. So the stock prices should go down as well. However, if investors seem to be pricing in rates peaking, now you have a lot of the media talking about how there's one or two more interest rates still to be seen, especially by the Bank of Canada or by the Fed. And it looks like, off the technicals as well, that the tech sector is probably going to have a bit of a check back now. Would you agree with that, or do you have your own opinion?
Yeah, look, I definitely believe that things are a bit frothy here, but again, it's not broad based, right? So there's, again, large cap tech and specifically 5 to 10 stocks that have done extremely well. And then if you look at from a sector perspective, it's been semiconductors, for example, in the US, S&P 500 index. Um, and so again, it's not broad based. And typically, if the worst was behind us, then you would probably get the most, I guess, cyclically sensitive industries rallying, um, a little bit more of the risky assets rallying. What we're actually getting here is companies that have a very high durability to earnings for the most part, right? This is generally speaking in terms of the FANGs, right? They have very, very long dated cash flows. We'll take Microsoft as an example. I don't think anyone here is going to be, changing their OS from, you know, Windows to Linux, for example, their operating system, right?
Of
Or
course.
anytime soon, right? Like we're fully ingrained in majority of people are either fully ingrained in the um, Microsoft or Windows ecosystem or the Apple ecosystem, right? And then again, the Office kind of um, applications are another key element that really remains quite sticky. And you think about all the data and everything that we're doing on a day-to-day basis as consumers, whether we're taking pictures, storing our data, want it accessible across various devices. Well, corporations want the same thing. So again, you know, big picture perspective, Microsoft, as an example, is a company that continues to remain relevant for all of us and is sticky if you think about our spend. So naturally, those earnings are going to be relatively durable throughout the economic cycle. We throw in, you know, a meme phrase, AI here, which is taking over just like crypto and blockchain not too long ago. Again, this is it's phenomenal what we've seen in a very short period of time. But again, in terms of moving the needle from a revenue perspective, or even from an earnings perspective, um, it's not going to be a needle mover for a company like Microsoft, but we can hope, and investors are hoping and praying that it does. And maybe this is another avenue of revenue for a company like Microsoft, and that's again that's the speculation, if you will. And for people that are looking at an Nvidia stock and they're saying, hey, look, you know, there's this boom that's happening. People are going to front load a lot of their needs for these chips, and so therefore, you know, it's a self-fulfilling prophecy here, right? Again, but that's
Absolutely.
typical you kind of euphoria, and this happens throughout various stages in the business cycle. Um, there's just a
Well, yeah,
lot of capital that's
let's just recap that a little bit. Like if
yeah,
you go back even just the past 2 years, we've had the meme stock craze, we've had EV stocks, we've had SPACs, we've had any sort of ESG theme, blockchain took off. All
yep.
of them came crashing down. That was really the most frothiness the market has been since 2001, and it's cooling off. And then now you have, Chat GPT and all the headlines behind that, even professional investors getting caught up in it. Like a lot of VCs are turning the tune to only investing in AI driven companies now, and it's gaining the momentum on the retail side. So you've seen companies like Google or like, to your point, Microsoft or Nvidia rocket up. And I mean, to your point, Nvidia, I think they're gonna do a massive issuance right now, which should probably keep the stock price in check. But there's the old saying, don't own the gold mining companies, own the companies that manufacture the pickaxes. In this
Yeah.
case, Nvidia is, the pickaxe manufacturer. It is the layer that all the AI companies will be building on top of. But, we need to keep in mind that this does seem like another hype craze. So, be weary out there. Don't go and throw a ton of money into a company that has already gone up, has doubled
Hmm.
in the span of a couple weeks because of all the news. You know, sell into, you should buy the rumor, sell the news is kind of the what we like to say. So, do you have any thoughts on that? Do you think that Nvidia, do you think other AI companies are something to stick around with, or is it getting a little too frothy?
I think generally speaking, and the guidance that we've deployed or leveraged in portfolios over the years, through many of these manias, if you will, going back to the 2000s, and the recommendations that I give to advisors, investors alike, it's the price you pay dictates your return, right? And so, if you are overpaying for a stock or an asset based on just hopes and dreams, I think that that is dangerous, right? And you see this across all asset classes, not just stocks, bonds, tech stocks, Canadian, U.S. stocks. You see it in private assets too. You see it in real estate, right? Where the goal is that the asset will continue to move higher just because. Bitcoin, crypto, in terms of the value that one gets from it, doesn't really change much from day to day. But the goal from an investor standpoint is the speculation that someone else will pay higher than what you paid. So again, to each their own. If that is your strategy of investing, that's fine. What we advise investors to continuously do is understand why you're buying a business. And that's essentially what you're doing. You're buying a piece of a business. So if you're buying a piece of a business because you believe in the product, the services, and you believe in the durability of the return stream that you believe you can get over a particular time frame. again, the price you pay dictates your return. And if that works out in terms of delivering on that return expectation, then that's where investors should be investing. I think chasing hype, chasing the noise, chasing the news headlines, I think is a very dangerous path to pursue. And again, we just need to look at the last 2 years. We don't even need to look at the past 20 years in terms of how things have panned out. For many of these type of meme related crazes or manias, if you will, right? Like they don't end well, and for the most
No, they
part,
never do.
retail investors tend up, kind of getting the short end of the stick. And pot stocks in Canada, for example, if you just look at many of those stocks, where they're trading today, many years after they became legalized or pot has become legalized in Canada, again, they were never great businesses to begin with, right? So again, I think rule of thumb, invest in what you know, invest in good quality businesses. If by chance they are or can benefit from, you know, technology in some shape or form, again, that's just optionality, right? So if a Microsoft can leverage blockchain, can leverage AI to enhance the search, the Google search, or not Microsoft, but let's say Google, or but if even Microsoft in terms of the computing functionality for everyday users like you and I, well, we're going to continue to leverage their products and services. And Google, I kind of misspoke there, but similarly, Google's leveraging AI. If when we
Absolutely.
Google anything in that search engine, if it provides us with, you know, superior results in terms of, the list of stuff that comes back to us, well, again, we're going to constantly use or gravitate to using that search function versus the plethora of other ones that are out there, right? So it just strengthens their competitive advantage, right? I think that's key. So companies that can take technology, raw materials, and upgrade it and provide value for investors, and more importantly, where consumers are willing to pay more for it, or at the very least continue to pay for that product over a foreseeable future. Again, that again, is a good business to own, good investment to continue to focus on.
I just want to talk a little bit about a previous point you had around the market breadth, which really, as a preamble, the breadth is essentially, the participation in the market. So
Yeah.
if there's good breadth, it means a lot of stocks are participating on the upside. If there's bad breadth, it means it's very selective. If you take a look at the S&P 500, so the largest 500 companies in the US, publicly traded companies in the US, on an equal weight basis, and you divide it out by the S&P 500, which is market cap weighted, it's actually heading back down to like 2020 levels right now. So to your point, there's very selective in the market. There's only essentially a handful, mainly these FANG stocks,
Yeah.
who are the largest participants within the S&P 500, who are receiving all this additional capital, who are receiving all the investor interest and appreciating, versus on the downside, you have the other 490 companies, let alone, the small caps or the mid caps, which are definitely a riskier asset class to own right now. So with all this hype, with breadth being somewhat poor, with market macroeconomic data, chilling out a little bit right now, what are you paying attention to? What are you focusing in on for your own portfolio?
Yeah. So for me, again, I think, and for every investor, define your time horizon, define your return that you're looking for. So for example, for me, it's a 10% minimum with the margin of safety. Great. I want to stack my portfolio with securities, whether that's stocks, bonds, ETFs, which give me exposure to the various underlying securities, that can help me get to that return over a defined time period. Um, so if I look at just the example that you gave me, so I did the inverse comparison. I looked at the S&P 500 forward price to earnings ratio and divided it by the S&P 500 equal weight. Um, on a forward PE basis. And if I look at the ratio, it's at 1.2. So essentially 1.2 times the multiple. So the S&P 500 market cap weighted index is trading at almost 20% above the equal weight basket. Historically speaking, we've seen um, this extreme a couple times in the past 20 years, if not a little bit more. And again, in those periods, or the periods preceding these extremes, we've seen the equal weight basket outperform. So there's investors out there that are very macro focused and focusing on the doom and gloom out there. And they're sitting in cash. They're uninvested or not invested or sitting in bonds, very short duration bonds, what have you, because they're concerned of a significant downturn, in the foreseeable future. There's other investors that again are kind of throwing capital to whatever's working, wherever the breath is strong, wherever the momentum is strong, and they're doing that. To each their own. But I think this is where timing the market, that phrase, avoid timing the market. We just don't know what's going to happen and more importantly, when it's going to happen. But again, if you are looking out 3 to 5 years and that's consistent with your time horizon, you're looking at a 10% rate of return, you can easily get that. And if we go back to the example that the ratio analysis between the market cap and the equal weight, right now reflects a very good time to be actually buying the S&P 500 equal weight as opposed to the S&P 500. So while we cannot time the market and see if this narrow breath will change into maybe a broader breath or if there's going to be a correction, what I can confidently say is that I'm getting the equal weighted basket at a significant discount to where it's traded historically, relative. So I get exposure to those same 500 stocks, but more exposure to the companies that are trading at a discount. And again, these are 500 of the largest, most profitable businesses in the world, some of the most liquid investments. So again, if the doom and gloom outlook materializes to some degree, again, capital will likely stay in the safe haven securities of the world of investing in equities, if you will. So that's US equities, for example, right? Versus the more riskier in EM. So again, for investors that are kind of looking at their US bucket and they have an ETF, for example, that gives them exposure to the S&P 500 market cap weighted, well, a simple trade is, buy the equal weighted basket. If you're a bond investor, again, there's so many examples and so many scenarios that we've looked at over the past 20 years when interest rates have risen very aggressively, and when the curve has become inverted, and what typically tends to follow in the months and years ahead. In this environment and everything that we're seeing, despite that inflation is still running a little bit hot and the hawkish posture still remains relatively strong for most central banks globally, the amount of hiking that's been done has been quite considerable in the last 12 months. And that's not only in Canada, but in the US and globally. So the question
What,
that
the
I kind of,
fastest it's been since the 80s? Is that the...
that's exactly it. If we look at the G7 countries, the pace and even more importantly, the magnitude. So not only have they increased interest rates at the fastest pace, but also the magnitude only rivals that of the 1980s. So again,
So what happened after that? Do you
well, we've
have like,
seen,
did interest with interest rates being hiked that aggressively, did fixed income outperform once they've capped interest rates?
well, typically what's happened is, the curve became very inverted. So
So a
short interest
recession.
rates. Sorry?
So a recession?
So eventually a recession came because interest rates really slowed the economy. And that's what the goal was, to slow the economy and then indirectly slow inflation. So that's the only tool that central banks have, is raising or cutting interest rates. And their mandates tend to be to maintain full employment, control inflation. And again, The way you do that is by controlling the amount of capital in circulation. So it's not a perfect science, but you got one tool to really impact so many layers of the economy. So typically, what's happened when interest rates have risen at this pace, um, you've had recessions that have typically followed largely in the US, and consistently across major economies globally. And so that's resulted in short-term interest rates falling quite aggressively. So between 0 and 2, 0 and 5, if you will. Um, and you've seen the long-dated maturities essentially fall as well in terms of yields. But their prices essentially rise. So in this environment, what we're suggesting is adding to duration. So adding to long dated government bonds between 2 to 10 years, if you will, based on kind of the risk reward or your portfolio and kind of expectations in terms of your portfolio. But yeah, I think that's what we're suggesting. And
So
yeah,
just to jump in a little on the recession front, like we've seen, I think this is probably the most socialized upcoming recession ever. I think it's been the
yeah,
talk of every talking head out there for what seems like a year now.
yeah.
Do you think that's relatively priced in, and that's why you're seeing asset prices like the stock market hold in relatively strong? Like, the stock market's obviously a leading indicator. I think it's about 6 to 9 months of
I
leading.
think, look,
So
I
that
think
low we saw a few months ago, is that the low?
so I would say what people are saying versus um, how capital is being positioned, um, I think are two different things, right? People may expect a recession, but they're still positioned in equities, they're still positioned in bonds, they're still positioned in a way that would not be consistent with um, technically a recession. The key challenge with this, with the I would say the rhetoric of and even like the headlines that do suggest that, oh, this is the most anticipated recession. That may be true, but I don't think anybody really understands, or I don't think there's really a consensus in terms of how bad, how long this recession could be. So I think that's where there's still a tremendous amount of uncertainty. And I think that's not only with individual investors, but that's also with central banks. Like they just don't know. Again, the GDP print that we're seeing here um, from Canada, the relatively sticky inflation that we're still seeing even after all of these rate hikes, and that's not only in Canada but in the US, in the UK, globally. Again, these are things that are again puzzling a lot of investors. So the economy is holding in stronger than many are anticipating or have anticipated. Interest rates, again, haven't bled through to the real economy as quickly as some have anticipated. Consumers, corporations have held in. Again, this goes back to the point that I made earlier. You can't. There's there's no winning in trying to time the market, and this is the reason why. Because there's a lot of the front loading. There's a lot of things that change, and eventually will and should make an impact. But again, the timing component is the challenge, right? So some people are looking at the market and saying, all right, well, yeah, a recession is coming, but they're just moving that needle in terms of when it occurs, and using the day-to-day kind of economic corporate results to justify, okay, maybe the magnitude of this fall or recession or drawdown may not be that material. And so markets are holding in. But again, if you look at the global picture, it's not suggesting that. So if we open up our eyes and we look at, okay, like are equities broadly speaking believing that? No. I think it's rather a risk off type of mantra globally. US equities, US dollar, US bonds, treasuries, these are risk off in their own asset class categories from a global perspective. Um,
Right.
and you don't need to, believe me in this, but you could actually just look at the data. Look at how markets rallied with the China reopening in October up until March 9th when, the fiasco with the regional bank started with SVB. And up until that point, Hong Kong was the best performing market. That was a risk on a posture for markets globally. You saw yields rally, you saw those markets, those cheap markets, um, performed very well. Value markets performed very well. And on the flip side, the more defensive, large cap markets like the S&P 500 underperform, as well as the TSX. Since then, the opposite is true. So again, I think if we look across various asset classes, even commodities, what's happening across the commodity complex? Crude is tumbling, but what's kind of going in the opposite direction? Precious metals, gold,
Would you be
and that's been
buying
our
gold here?
look. I think what we've been recommending since 2021 year end was to strategically allocate to gold. In our review, gold typically does well in a very high negative real rate environment, in recessions, and late in the cycle. So, at the very least, it's a preservation of capital. I think gold kind of makes sense here in terms of the upside from where our initial recommendation around 1600, 1700 in November of 2021. Like, I think I can't expect that level of performance in terms of the commodity. But again, there's probably opportunities as it relates to various companies that again are miners and or streamers and that have again are creating value from the underlying commodity. But again, our view for any investor, retail investor out there, even institutional, our preference over the longer term strategically is to have allocation to the gold commodity. That's the lowest risk,
Absolutely.
kind of your
Well, the
best
gold companies
bucket.
do such a bad job of generating revenue and returning that to shareholders. It's like, why would you ever put your money in there?
Exactly. And I think the ones that do offer maybe a higher return, but, again, a higher risk is streamers. And then maybe some of the large cap after that, large cap gold miners, and then all the way down to the highest risk, most more speculative is on the far end of the spectrum is like explorers that are actually going and trying to prospect, find gold in the ground, and essentially pull that out at a profitable level, right? So in our view, having exposure to the commodity makes sense. First and foremost, being strategic in that posture, and then tactically, again, being mindful of allocating um, when the time is, again, reasonable.
Okay, interesting. So just to maybe to recap everything, risk off environment, especially from a lot of the media. However, the markets have been relatively resilient.
Yeah.
And would you say that on a go forward basis, if there is any sort of pullbacks in the market, you would be taking that as a buy opportunity?
I think to a certain degree, and it depends on the market. Again, it goes back to um, what an investor is trying to achieve, right? If they're trying to generate over a 5 year period a return of, let's say, 10 to 15% rate of return on an annualized basis, I would look for companies that have the potential to generate that. Right now, without any check back, there are quality cyclicals and quality defensive stocks in the US, again, that and even in Canada and globally, that are trading at very, very attractive valuations where an investor, if they were to put capital to work today in good quality companies, could generate a very, very respectable rate of return. So again,
Okay.
check back or not in the market, I think it really comes down to the security level. You can make the case for bonds here, where again, just based on how bonds have behaved um, heading into recessions, how the yield curve has behaved, how policymakers have responded to recessions, a slowdown, even equities globally. Again, you can create a very good portfolio today that can again generate a return risk reward that again is in the ballpark of 10 to 15%, likely with the lower risk profile than the broader market. So again, don't wait for a check back. If there's again, if you have capital to put to work, I would start finding those opportunities. And there's various tools, various ways to do that. If you're up 100% on a stock that probably shouldn't be up 100%, or maybe there's a little bit of euphoria built into that, take profits, right? You can hope and dream that you get
Absolutely.
another 100% in the coming months. But again, I don't think that's a reasonable expectation, right? And
You
I would
won't go
take
broke
profit,
taking money off the table. Yeah,
take money, and I think if you're a retail investor, it's there's the mantra of like sell in May and go away. There's also trim in May and still stay active. There's buy low, sell high, and maybe it's not selling your full position, but trimming. Because again, what I remind investors, and I hear this all the time, let your winners run, cut your losers. I think what is very concerning about that last statement, which I hear across many many retail investors, is that there's a tendency for concentration risk, and that won't rear its ugly head tomorrow. But if we just look back at the last couple of years, what you want to avoid is being Shopify, being Netflix, being Meta, being even Nvidia, where it was trading at 100 bucks. If that was your winner, or Tesla, if you were buying all the way to the high and these things get cut in half by, to the tune of 50%, if not more, you're really you're caught in a pickle at that point. But if you're trimming and taking your profits and still again owning a reasonable allocation to these great companies, what you're doing is you're managing the risk within your portfolio while still staying centered on that return and allocating your gains, the profits that you've taken off the table, to other great businesses. So again, what I've said here is risk return. I always risk reward. It's always like the return that you get is always in relation to the level of risk you're taking. So by taking profits off the table, rebalancing on a regular frequency, following a more systematic approach to doing this, again, this is what institutional investors do, some better than others. And I would even
this
say
is what
retail investors
InvestaPal
better
helps
than
you with.
others. Sorry?
Yeah. So this is what InvestaPal helps you with.
There you go, right? I think that is leverage the tools, leverage the resources on the platform, and even others on that are out there, right? To again allocate during challenging environments, and even taking profits during the craze and the euphoria, right? I think that is probably taking money off the table, not necessarily sitting in cash. I would only suggest going into cash if the alternatives out there are worse than cash over your stated time frame. And if they're not worse than cash, or you can get a return that is better than putting your capital in a 90-day T-bill, well, then that's probably not the best bet for your money, best bang for your buck, if you will. So
Yep. Absolutely. Okay, so own high quality companies. If we're looking at the SP 500, they're all in a broad sense high quality. You could focus a little bit more downstream on those and not off the massive market cap tech companies, but a bit more of that mid tier market cap, still high quality. Gold, you think is interesting. Fixed income, long duration, you think is more
adding
interesting
to
here for you?
duration, I think it makes sense at this point in the cycle. That's not to say that yields are going to collapse or the yield curve is going to continue to kind of fall here, shift lower. But what I'm saying is that it starts making sense here, adding govies, high quality corporates, very, very high quality corporates that have
Actually,
strong
maybe
balance
maybe
sheets, not at risk of defaulting or anything like that, missing a payment. I think, again, those are all fair game.
okay, interesting. And to focus in on that because I do think it's of interest. for the past few years, fixed income has been unstomachable for most generalist investors out there. The rates on them have been atrocious, but we're now back to an environment where the yield on your fixed income sleeve is pretty enticing. Do you think the 60/40 portfolio is back in swing again and investors should actually start allocating money back into fixed income and not be 100% equity?
Well, if you had a 60/40 portfolio and that was consistent with your willingness and all the risk objectives and return goals, and you went to 100%, I would definitely rethink the process and all the guiding principles, because again, that's a heck of a lot more volatility, managing, kind of investing in a 100% equity portfolio from a 60/40. So that's first and foremost. What I would say that some investors have actually gone to the 40 portfolio, the fixed income component, and have augmented it with stuff that is um, maybe not as volatile, private, or stuff that is illiquid. Again, I think to compensate for the low yields, I would strongly consider looking at a lot of those products or solutions, and kind of making sure that it's still consistent with your risk return goals. But I definitely think public government bonds in Canada, the US, and even corporates are definitely compelling at this point in the cycle. And just generally speaking, relative to what they've been yielding historically, um, I think they make sense. So again, high quality. I like sovereigns here, govies in Canada, the US. And again, that's kind of what we've been recommending. If you can get 3 to 4%, going out 5, 10 years, and that's just your coupon if you hold to maturity. But typically, as you get into, slow down, interest rates typically get cut. Historically speaking, again, we go back 50 years, that's what's happened. And yield curves essentially shift down. So you not only get your coupon, but you also get a price appreciation as part of your return, right? So again, there's
Yeah.
a real opportunity that investors can kind of benefit from that, across the medium term, to long term, sovereign areas of the curve.
Okay, lovely. I
And
think
one
this is a
last thing on the
natural.
equities. I know we've been focusing primarily on Canada and the US, and probably a little bit more on the US, but for investors that, again, that have the tolerance, I would strongly look at developed markets outside of Canada, the US. The US in particular, if we look at the market cap weighted index, the S&P 500, it's trading well in excess of what we've seen in terms of valuations over the last 20 years versus global indices. So again, the risk reward is very, very compelling, across many developed markets, outside of essentially the US, right? And even to
Do you
some
think
degree
there's a
Canada.
risk there though? Like the US is primarily the safe haven. Developed markets are second to that. Developing markets on the bottom of the barrel.
Yeah.
So, based off of where we see the macro climate, investing in non-US assets still seems like a more of a risky investment area if we think that there's going to be a slowdown.
That's fair, but again, I think I would say that there's other markets that are pricing in a lot of this negativity already, and that's across the developed markets. And these are markets also that, again, parts of Europe, Asia. Think about Japan. Japan's performing very well. France CAC 50 is 50 of the largest global companies. These are names that we're very familiar with, um, that are not necessarily exposed to just what's happening in Europe, but again, the global picture, very solid businesses. So again, I think if you take a look at it from a market perspective, there are definitely stronger, more compelling opportunities from a risk reward over more than a very short term time horizon. So again, beyond a year to 2 years, if that is where an investor is kind of positioned 5 years out, maybe 10 years, it's an easy sell to go outside of the US, despite kind of what we're seeing. More importantly, many of these markets are pricing in a lot of the negativity. Not all of it, but they're pricing in a
Mhm.
lot of the negativity. So again, your downside is 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 limited, I would say, in terms of um, what could potentially pan out, even in a worst case type of scenario. Because again, all the capital's hiding in a lot of the safety assets, as we've discussed. Um, and then three, a lot of these global companies are tilted towards so many different economies. They themselves provide investors with great diversification in terms of the revenue stream. So they're not isolated to one economy, one region, one type of consumer. So again, I think it warrants, especially where valuations are, investors to kind of start at the very least, um, kind of dabbling in some of these markets, or at least dipping their toes in some of these global indices, global markets. And again, there's ways to do that from an ETF perspective, in terms of CAD dollar ETFs that are traded in CAD dollars. You can do that through ADRs, so American Deposit Receipts. So there's many ways to do it where you can limit the currency impacts, and still have really good liquidity and exposure to markets that, again, from a risk reward, make a lot of sense, right? So,
Yep. Okay, lovely. Well, Nadeem, I really appreciate the time today. How, if anyone's interested in following along to you, how could they find out more? Where can they find you?
sure. So, we publish a lot on LinkedIn. So, you can just search my name on LinkedIn, Nadeem Kassam. I think my LinkedIn um, ID is NK2. So you can find that either way. And yeah, we're always happy to jump on this podcast and others. So keep a lookout. A lot of research on my profile on LinkedIn. So again, you can kind of look at past commentary, and I'm pretty active on it as well. So you can get kind of regular views on an ongoing basis.
Awesome. Okay,
Perfect.
sir. We'll leave it there. Thank you, everyone, for listening. We'll catch you on the next show.